Okay, welcome everyone. We'll start our lesson 3. Good afternoon, and today lesson will go through LO3 learning outcome 3. As you know me, my name is Anjum. If you have any question, please drop me email anjum@ukversity.co.uk. I'll try my best to get back to you as soon as possible. We'll start our LO3. So all the resources available regarding LO3 as well on our Moodle page. So please you can follow our Moodle page accordingly. So today lesson will be our LO3, which is about be able to prepare financial statement for group of entities. Group. So what is meant by a group? So in a group there can be parent company, it can be subsidiary company, and can be associate. So 3 associate company. So parent which own more than 50 or more percent of other company shares, that's it called subsidiary of the parent. If you own it 20 to 49% shares of other company, so that will be your associate. And other than if you have own the shares less than 20%, that will call simple investment you have. So that's the way within the group we were. Okay, so in the group we always try to find the goodwill in the group. Yes, when we prepare, we do NCI, non-controlling interest, and will retain earning. Always please, when we prepare, of course we can pick examples. I'll show you retain earning of group, all the parent and subsidiary post acquisition. Yes, post acquisition, because we don't have any concern pre acquisition. Okay, that's where it will be. So always good to be reflect what your current knowledge about financial statement and consolidated, and then we can start. So indicative content today lesson really will go to be able to prepare the financial statement of a group of entity. It's a statement of cash flow, structure, preparation of the group account, associate, joint arrangement. So how the company and group structure, which it can be how many percent you own. So prepare the group including the statement of the cash flow, requirement of the cash flow, the statement of the cash flow, summarize all the movement of the cash. There we can 3 activities in the cash flows: operating, investing, and financing. Always keep in mind, yeah, operating, which is our normal business operating activities, is our normal business, like Tesco as a supermarket. Their normal business to sell the consumer goods. These activities is called operating activities. Then sometimes they have a spare cash. They invest in the properties and various other businesses. Those called investment activities. So we can find how much money in and out from investment activities, which is consist of non-current asset. Previous years increase or decrease in the non-current asset that can be affect the movement of the cash, which we look those. Then we have a financing activities. Yes, so financing activities, it can be consist of non-current liabilities, which is mean long-term debt, and the changes happen, and always look the share capital what's happened last year. So finance can be two activities, because the finance you borrow money through debt or debt financing and equity financing. So we can look around the changes, and we can say increase and decrease in the cash. If we settle the liability, the cash will be less. If we liabilities increase, it can be cash balance. So that all will be in our discussion, which we can prepare the statements. Okay, because it's not your exam, so we focus on how we can meet the learning outcome. Okay, operating activities under IS 7 International Accounting Standard 7, we deal with the cash flows. We can prepare the cash flows under IS 7 International Accounting Standard 7, direct, indirect method we use. Okay, so you will see here the layout. So when we prepare this statement of cash flows, we can start profit before tax from the income statement, or we call statement of comprehensive income. Then you look the adjustment finance cost is not here where we can first we can add it back, because profit before tax, it can be after the deducting finance cost, you can add it back. Depreciation is a non-cash expense. If it's a given in, you can add it back. And dividend received, if any dividend received, you put it credit. Now we need to do debit to reduce our income, because the dividend received come under investing activity, not under the operating activity. Gain on the disposal of the property is the first place you add it as other income source, income in the statement of comprehensive income. Now we need to be minus, because it's come under the investment activities, not under the operating activities. Increase or decrease in inventories, these are part, so when the inventory increase, the cash flow will decrease. When inventory decrease, the cash will increase, have an opposite effect. Yes. So less inventory, more cash, more inventory, less cash. Trade receivable, if trade receivable drop, it means you receive the cash. If trade receivable increase, it means your cash is stuck with the customer. Trade payable, if yes, it's the opposite. If you settle, if increase trade payable, it means positive cash flow, because you're not paid them. If you decrease the payable, it means the cash is went out from the business, that's decrease, opposite of receivable. Cash generating from operation, interest paid, how much interest, which is also known as finance costs you paid during the period. Tax paid, so always look around the tax, how much you paid, because we have only concern not payable, paid, because it's a cash flow. So, and that's your indirect and direct method. You can say cash received from customer, which means trade receivable, cash paid to suppliers, cash generated, interest, tax, and that's the way we can, under direct and indirect method, we can calculate the cash flows. Okay, guys. Next we look the net operating activities. So we have investing activities, purchase property, plant increase during years, last year, this year. Proceed from the disposal of asset, so cash will go up. Dividend received, which we minus in the operating, we adding here. So then we can say net increase is a decrease, cash is a positive or negative balance. You have a financing activity, proceed if you issue new shares, cash can be positive. Increase the bank loan, positive. If you paid dividend, yes, on the, that's received dividend is the income, paid dividend is expense. So that's only you paid dividend when you borrow money through equity finance. So net cash used financial activities, and then we can say financing, investing, and operating. What net effect you have, increase or decrease at the cash flow. You have opening balance of the cash flow, which is given the last year closing, this year opening, and then this year closing balance always given in the statement of financial position. So all your reconciled figure, it should match the cash balance you have in the balance sheet, which is given. Okay, so that's the way we can reconcile and we prepare the cash flow. Any question if you have, you can ask, please feel free. Yeah? Okay, so then preparation of the cash flow, this is all explained how we can, as I explained in the previous slide. Okay, so advantage of the cash flows, cash alert user to the liquid problem, shows how well or badly the profit is converted into the cash, because the profit is not being the cash, because it can be credit sale. That's why cash is the lifeblood for any business, and cash flow statement to look and make the right decision is very crucial, and we need to be look around all the estimates and things. We look actual cash, what we have. Limitation, cash balancing can be manipulated by delaying the payment to suppliers sometimes. So cash position look good. It's possible to focus on the cash flow, that expense, profit, yes, and replacing the plant and equipment in the long run the business needs to survive. Historical information is not necessarily reliable indicator in the cash. Okay, so please, we have on our Moodle page, we have a handout which is given Osborne handouts. You can look around under chapter 6, please, 6.3, 6.4, the question about the cash flow. You've been given the question and answer. Try keeping in view of the template you've been given on our these, lecture slide or PowerPoint slide, which you can use them. And when we'll do assignment, so we can pick either question from this handout or any other handouts of your choice. Okay, then you have 3.2, prepare the group account incorporating associate and the gender arrangement. A group is the company consists of parent, subsidiaries, associate. They have a single economic entity. Between, if we do the trading with each other, the intra-company trading, we need to eliminate to show the true and fair figures and consolidated income statement, single economic entities, investor control and investees and investors exposed, and the rights and various return and the powers, all which we can disclosed under IFRS 10, International Financial Reporting Standard 10 about consolidated. We have a IFRS 3 as well, which is mean combination of the business units into one to represent and show how the group is strong. And the entities of the subsidiaries, parent control is the investor control, investees. If only the investor has all the following: power over the investees, exposure of the right, variable return, investment in investees, and the use of the power over the investees to affect the amount of the investor's return. So power, investor has the power over investees when existing rights that give the current ability to direct its relative activity using the normal trading activities. The most common rights which we can look around: the voting right, we have an AGM, annual general meeting, and this is the statement of financial position layout, how we can parent and subsidiary. So establish the group structure. If you own it 80% shares of the company, so you have to look around what is the 80% shares meant by the share capital. 80%, that's and we look the net asset minus, and the difference will be the goodwill which will pay. Calculate the non-controlling interest. We can say share capital of acquisition, which is 20%. If you own it 80%, non-controlling interest is 20, because everything is 100%. Return earning at acquisition, how much was of the subsidiary, 20%. Fair value adjustment, if the asset value during the period is increased and decreased, thus we can adjust it. It's always given in the question. And non-controlling interest acquisition, so we can find it how much goodwill. Of course, goodwill of the company, we can calculate it. Consideration, how much we agree to pay, how much is the non-controlling interest we have. Net asset, when we acquire, what is the net asset accounting equation? Always look around total asset minus liability is equal to net asset. So net asset always equal to equity figure. If is the net asset, we receive the money more than the net asset. Why we received it? Why we being paid more than the net asset? Due to the goodwill. Okay, so impairment of the goodwill we have, it can be impaired from that date. So impairment is a loss, so we can reduce the goodwill and the impairment losses goes. Here we are doing credit in the statement of comprehensive income. We'll do debit as an expense. Expenses, we do debit, double entry booking. Consolidated statement of financial position. So calculate this consolidated return earning of the group. We can look around statement, yes, profit and less acquisition, the group shares, how much we have, so we can find it, return earnings. So all the parent and subsidiary post acquisition. Okay, so please always remember an impairment we can make adjustment as we discussed, because normally income is a credit and impairment is a debit, so that will be crossed out. The losses and the net income will be left. So calculate the non-controlling interest at the end of the year. So share capital, return earning, fair value adjustment, and non-controlling interest, how much we have, that goes in. consolidated. So you will see there the layout, please. Step 6, intangible, which we calculated the goodwill, all the non-current asset of the parent and subsidiary we merge 100% because doesn't matter we own it 80%, but it's not mean we'll calculate because we have a significant influence on decision making and the governance, and the company showed the single economics unit. Current asset, all the parent and subsidiaries, and equities, only the parent. Return earning, which we calculate parent, all, and subsidiaries, whatever the percentage post acquisition. Non-controlling interest 20% we calculate, and then we can say that's our total equity and asset, and that should be equal to our total asset and total liability plus equity should be equal as the accounting equation, which you can. Okay, so guys, this is the way we can make adjustment and all the steps you've been discussed. As I mentioned, if you have a question, please you can ask. Any question?
Yes, sir. Let me ask this. Hello, sir.
Yes, please.
In the calculation of the goodwill, we have the proportionate method and we have the full method. So can we use any of them, or strictly going by the full method?
Whichever you use, no problem, because only the learning outcome consolidated example.
Okay.
Because it's not exam, so it's assignment based. So you can pick of your choice.
Okay. For more precisely, we can even use the 2 just to explain further.
Sorry, which one?
I said you can choose to use the 2.
Yes. So you and underneath you can explain it. Yeah.
Further, yes.
So we can say you prepare the consolidated statement, whichever method you use, and underneath you can put the figures, because that's absolutely fine, because the assignment brief says you prepare the consolidated statement of the given data. The data you can pick it here, and you can use it as example.
Thank you, sir.
You're very welcome. So yes, please. I'll give you separate handouts. We have a lot of, if you want, so you can use it either from ACCA and Osborne and AAT books, all available. Okay, so that's which we can prepare the consolidated profit and loss as well. Revenue, intra-group or intra-company trading, we need to eliminate always cost of that. Unrealized profit, if we make the profit, we include it in our separate statement, but when we prepare the consolidated, we need to eliminate it. Operating expense, profit from operation, finance cost, profit before tax, and all these we need to be. And then attribute, we can calculate it, please, non-controlling interest, and as well, which we can show under the attribution. Okay, yes, that's if we need to make increase adjustments, we can intra-company, any losses and further points. And we've been given the question, if you want to pick consolidated Osborne 8.4, 8.5, please, of the handout, which you can use either Osborne, number of other resources also available, and either if you want to set up your account on Open Tuition and look financial reporting of ACCA, which is F7 exam, which is also quite good too. You just go online and do Kaplan and consolidated statement. We can find the chapter of the book, we can read it, which I further demonstrate during our assignment discussion as well. Prepare the group account that involve the changes in the group structures. Yes. So if the one company own more than 50% ordinary shares of another company, this is the first control, the second company, the first company, the parent, and enough, the voting power to appoint all the director and the second subsidiary company. SP is the fact able to manage S as well, which we can look around these. Fact, we have IES, which is 27 consolidated and separate financial statement. So we can prepare subsidiaries, we can make it group, we can look around if any changes happen, so we can demonstrate according to IES 27, International Accounting Standard 27. Okay, then The consolidated income shows generated all the resources disclosure and related to consolidated statement of, yes, which we can look around in, and the financial position, net asset of the parent, and the subsidiaries which we just mentioned earlier. Thus, any changes made mid years which we need to be proportioned accordingly and separated. And the mechanism of consolidated the statement of financial position, commonly the standard working produce the consolidated statement group diagram. Yes, where you can group structure, you can highlight it, the net asset of the subsidiary acquisition, goodwill calculations, all those we can highlight and we can show. And please, we included here links. If you want, click those links, that will take you and you can read further, and you can add it some example if you want to look around. And please, we have 8.6 question in the handout of Osmond, which you can look around if you want more question. If you want to work toward the merit criteria, analyze the accounting requirement related to the foreign transaction due to the increasing globalization, business operations towards the internationalization, financial reporting. That's why we have a standard financial reporting standards we have to make and reflect an harmonized system in throughout, like the revenue, turnover, sales. Yeah, so we use word now revenue. IFRS are not enforceable in any country. They are developed by international organization. They have no international authority to be enforced. They must be adopted by the country national financial reporting standards settler within the European Union. IFRS is adopted for all the listed entities from 2005, and IFRS including in various other countries as well. They adopting because we're moving towards more international reporting because of investment throughout the world. And please, we have further reading here. If you click the link, you can. And if you move to the further, if you want to work toward the distinction criteria, evaluate the needs, prepare the detailed financial statement when the changes in the group structure. So please, we can look around the all the fair value adjustment, impairment, goodwill, and asset revaluation. So we can show those if we prepare with the changes these, and that's we hitting the criteria of our distinction criteria. Then it's mean you can yes, fair value adjustment we do according to IFRS 3, International Financial Reporting Standard 3. Fair value adjustment, what is meant by fair value is mean the market value which we can look around, the value in use and economics value. These always we can look around the impairment. We have a separate IS 36 or 37 as well, provisions. And the goodwill calculation, fair values of subsidiary, identify the net asset which we as mentioned. And if you calculate and you explain it, so you're hitting the distinction criteria, so you can get it. And here we included the link for further examples and the resources, technical article on consolidated arrangements and how we can. So these example, if when you pick and you will use, so it means you can hit your distinction criteria to solve it, and thus you can work. So in our following lesson, which is lesson 4, which is we'll go through LO4, where we look the financial statement interpretation of, and then the following week we'll do the assignment discussion. Okay, so please, all the handouts is I'll take you back to is available on our Moodle page. So please, you look here. We have all the resources you will see here for the books. And if you scroll down, you will see the Osborne, which I just mentioned you. So please, it's good. Other than that, you've been given a lot of examples here, different tasks. Other than that, I can share with you a few extra resources, ACCA booklet. So that's if you want to pick some examples, you can. If you give me 1 minute, I can share in the chat. F7. please. Here is the F7 resources, which is all covered. Yes, so you can pick question from there. And if you want to further look any other, drop financial statements, consolidated. And DF. Okay. So please, in the chat box, from the chat box, you can download these as well, and those are available, and those you can use as well. And if you want to explore more, you can from these. And if you have particular questions, please free ask me. That's all from my end. So today we discuss about consolidated financial statements. We said we can prepare the profit and loss. We discuss about financial position, and under IS7 we said we can prepare the cash flow statement. 3 activities: operating, financing, investing, and that all was in our discussion. And we said you can pick the examples to use in assignment. I'll share with you the resources. Thanks for attending. If you have any question, feel free, please ask me.
Yes, this one on the assignment sheet, there is a student number, but I don't know whether I don't know. I don't have any student number. If was so, you know, at the cover page of the assignment, you're supposed to write your student number, but we have not been given student numbers.
It should be our student numbers, and even you put your name, we can track it, because you know we have and you can drop emails to our admin team, and they should give you the student number as well.
Okay, that's the first question. Then let's come to the course itself. For the LO3, learning objective number 3. So if you want to achieve distinction criteria, doesn't mean that you are supposed to solve various questions, because one question under consolidation, you can get the introduction and you can also get a foreign subsidiary, or each one should be different question.
Because the distinction criteria with some adjustment, like intra-company trading and things. If it's if you're the simple question, you pick it, then hit the criteria of consolidated. If you're putting with the adjustments,
yes,
then it's mean you're hitting the distinction criteria. So you can pick one question with the adjustments, all bit, so that can hit the distinction criteria.
Okay.
Explained that you can say yes, as you can refer back like 1.1 or 1.2, like 3.1 and 3.2, as I discussed, explain in 3.1, and you can give the details.
Okay.
That's distinction criteria, which is fine.
Okay. Thank you very much.
Very welcome. Yes, David, any question you have? If you have.
No, I haven't got any question for you. Okay. Thank you.
Thank you. Have a lovely weekend, and speak you next week. Thank you.
Thank you.
Thank you.
Okay.
Bye-bye.
Bye.